Hello everyone, good afternoon. I hope you will be fine. Today we are going to discuss about depreciation. Last time we discussed the cost capitalization issues for property, plant and equipment, like which costs we have to capitalize for building, land, leasehold improvements, land improvements, right? Plant and machinery. So these things we have discussed. We also discussed about capital expenditures and revenue expenditures, and we also performed some couple of questions. So today we are going to discuss about property, plant and equipment depreciation. This is an important topic also. And after the completion of depreciation, so whatever the syllabus is there for your book, it will be over. So what is the depreciation? Starting with the definition. Actually, depreciation is the process of systematically and rationally allocating the depreciable base of a tangible assets over its expected useful life. So we have to look the words, we have to understand the words. Number one is, what is the depreciable base? Depreciable base means to say we need initial cost of the asset. From there you will deduct what? Residual value. So if you take cost of asset minus residual value is also called salvage value. It could be given with the name of scrap value. So if you will deduct from the initial cost, so this is called what? Depreciable base. What is initial cost? I told you last time it will include all those costs which we will incur to bring the asset to the present location and to the working condition, right? Which will include purchase price, less rebates, less discount, plus transportation cost, plus non-refundable taxes, plus installation charges, plus site preparation cost, plus dismantling cost, plus interest cost in case of it is capitalized. So this will include all the cost. And now we need to understand what does mean by residual value. So before the understanding of residual value, we need to understand what is the expected useful life of the asset. Expected useful life of asset means to say this is the life of the asset over which we expect the benefit from the asset. For example, you bought a car and it is your intention that you will use this car for 5 years. It means expected useful life for you is 5 years. Maybe same car I am planning to use only for 3 years, and after 3 years maybe I will replace it. So for me, the same asset is having a life of 3 years. Like useful life means this is simply intention to use, right? So now what is the residual value, which is called salvage value also? If I'm planning to sell the asset after 3 years, I mean after useful life, so what value I will get through the sale? What value I will get through the sale of asset at the end of useful life? So that value I'm estimating today, and that value is called what? Residual value. So when you take cost minus residual value, so this is called depreciable base. Depreciable base means that this is the amount which should be depreciated. And why we deduct residual value? Because this amount you will recover it through the sale. So this should not be depreciated, right? I hope it is clear. Please, guys, when you are joining, switch off your mics immediately. So now, guys, this 2 words we have understand. Now, what is the systematically and rationally, or what is systematic and rational allocation? Systematic means to say the depreciation, it should reflect the pattern of benefit consumed. For example, if I have asset and I'm planning to use this asset for 3 years and I have planned to use it equally every year. So then it means I need to select a depreciation method which should give also equal depreciation. The reason, because I'm planning to drive the benefit equally every year. Or if I have school of thought that I will use this asset more in earlier years because it is new, and less in later years because it will get older. So then I should use the depreciation method, which should give me higher depreciation in the earlier year because I'm taking more benefits, and lower depreciation in the later years because I'm consuming less benefits. Clear? So this is what is called systematic and rational allocation. Like there must be some rationale to select the depreciation method. But there is one point under US GAAP, even your method is not reflecting the benefit consumed pattern. So still you can select any method. This is GAAP, this is relaxation. Like regardless of benefit consumption, you can select any method. But under IFRS, it is more strict. So you have to select the method which should reflect the consumption of benefit, pattern of consumption of benefit. Okay. So now guys, depreciation we will calculate obviously. So it is a node. You should also remember this node being a student. So the depreciation method chosen should reflect the pattern in which the economic benefit or services from the assets are expected to be received. Even GAAP give you relaxation, US GAAP, but still you should rationally you should select the method which will reflect the pattern of benefit consumed. Understood? Now, the depreciation calculation we will see, but so far assume if you know what is the depreciation expense, for example, you know, let's assume depreciation expense is $100. So you will pass this entry. First explaining just entry. What is entry? Entry to record the depreciation is we will debit the depreciation expense and we will credit the accumulated depreciation. The debit side will be recorded as an expense where in the income statement, and credit accumulated depreciation. Actually, it is a contra account to the asset cost. You know, in balance sheet, how assets are reflected? You record the cost of asset less what? Accumulated depreciation is equal to what? Carrying value of asset. Carrying value is also known as net book value, balance sheet value, or net value. Okay, so this is how you record the asset in balance sheet. So that is why I said accumulated depreciation, because over the years, accumulated depreciation means say depreciation till date, total depreciation till date. Over the years, accumulated depreciation will increase, and obviously your carrying value will decrease. Cost is not going to change until unless you have some capital expenditures. Understood? So it means this accumulated depreciation is a contra account to the asset. Why contra? Because we deduct from the asset cost. That's why we say it is contra account. Understood? Now guys, I have already explained what is the depreciable base. I already explained what is the useful life. I already told you what is the salvage value. Understood? So now I'm just talking about this note. You also need to remember land. Land always have what? It has indefinite life. We don't know the life of the land, right? Until what time it will last. We don't know. Right? So that is why land must not be depreciated. But building and other assets which are having finite life should be depreciated. Understood? So far just we discussed definition. What is depreciation? I told you in depreciation you are going to allocate the cost of asset over its useful life. Cost means a depreciable base over its useful life. And it must have some systematic and rational allocation. Right? Then I told you what is salvage value, useful life. Right? So here we go now. We have a small just example, and because this example we will continue to get the depreciation by using different methods, and at the end I will show you some exam standard questions, like which type of questions might appear in your exam. For example, here we have example Jayhawk company recently acquired a robot to be used in its fully automated factory for the purchase price of $800,000. 50,000. This is the purchase price. Jayak spent another 150,000 installing and testing the robot. Obviously, this 150,000 is also capital expenditure, must be capitalized. The company estimates that the robot will have 5 years useful life and can be sold at the end of that time for how much? $100,000. This is residual value. So if you want to calculate, for example, what is the initial cost? Initial cost should include purchase price plus testing and installation. So it means your cost is going to be how much? 1 million. Right? If you want depreciable base, you have to deduct from here what? Residual value, which is how much? $100,000. So $900,000 is called your depreciable base. Please make sure your accumulated depreciation should never exceed this value. I will tell you this point with the different examples, but this is really, really important point. Your total accumulated depreciation over the years should never exceed the depreciable base. Because if depreciable base amount which can be depreciated is 900,000, your accumulated depreciation obviously should be maximum $900,000. It should not be more than that. Right? In other words, this is another way to say, your asset should not be shown lower than or below the residual value at the end of useful life. Your asset must not be shown below the residual value at the end of useful life. It is same thing I'm saying, but from two different angles. Because if I will take cost of asset minus what accumulated depreciation, and I said accumulated depreciation must be how much? Equal to depreciable base, right? Cost is how much? 1 million. Obviously, your asset carrying value at the end of useful life must be how much? 100,000, which is equal to what? Residual value. This is what I'm saying. Because if your asset will stand at lower to the residual value, it means your accumulated depreciation is more than depreciable base. Agreed? This is what I'm saying. Don't you worry, this point I will prove with the calculation. Maybe so far it feels, maybe you feel it is complicated. It's not complicated at all. Don't you worry. But this point you should remember. What I told you, your accumulated depreciation, let me write. Accumulated depreciation over the useful life of asset should be or must be equal to what? To the depreciable base. It should not be greater than special. Sometimes you sell asset early. Accumulated depreciation could be lower than depreciable base, but it should not be more. Understood? This is the point. Now, guys, I'm going to explain first depreciation method, and I need your concentration. First depreciation method we are going to discuss, that is called what? Straight line method. Straight line. And what will happen under straight line method? It is one of the simplest method of depreciation. And here what will happen? Ideally, you will get equal amount of depreciation every year. Okay? Equal amount of depreciation. But the point is that how to get the depreciation. So this formula you will apply to get the depreciation. And don't forget depreciation. Mostly we calculate at the, obviously we should calculate at the end of the year. Every year, every counting year we have to calculate as an adjusting entry, right? So what is the formula you will apply here? For straight line method, this formula just you need to remember. We will take cost. This is the depreciation expense every year. You need what? Cost of asset minus what? Residual value divided by what? Useful life. Right? For example, if I'm using same example, let's assume if My cost is 1 million. Residual value is how much? 100,000. Life is how many years? 5 years. So this will give me annual depreciation of how much? 180,000. Understood? I'm telling you shortcut. This depreciation expense is what? Per annum. Now tell me, what is the entry which you will pass every year? What entry you will pass? You will debit depreciation expense every year with 180,000, and you will credit what? Accumulated depreciation by 180,000. Clear? Understood? I'm saving your time, taking you to those points which are useful to solve the exam questions. For example, same data I have, and examiner is asking you to calculate what is the accumulated depreciation at the end of third year. What you will do? You have already annual depreciation. You will just multiply with what? With the 3 years. So this will give you accumulated depreciation of 540,000. This is accumulated depreciation for 3 years. If you want accumulated depreciation for 5 years, multiply by 5 here. If for 2 years, multiply by 2. Sometimes examiner might also ask you, what is the carrying value of asset at the end of third year? At the end of third year. And what is the format for carrying value? Carrying value is always equal to cost of asset minus what? Accumulated depreciation. And this carrying value I'm calculating at the end of which year? Third year, for example. So what I will do? Cost was 1 million. Accumulated depreciation for 3 years is how much? 140,000. So whatever 360,000 will be your carrying value. Understood? I don't think so there is any rocket science, right? It's quite simple. Sometime one more note. Sometime maybe you want to calculate depreciation percentage. What? Depreciation percentage. Right? Depreciation percentage. So how, if it is not given depreciation percentage, maybe you need, or straight away this could be as simple as MCQs also. Like what is the depreciation in percentage? So simply what you will do, you will take 100% divided by useful life of asset. Useful life of asset. This will give you what? Depreciation percentage. For example, in this question, what we discussed, if useful life is 5 years, so 100 divided by 5, it will be how much in percentage? 20. If useful life is, for example, 10 years, so then depreciation percentage will be 10%. Right or wrong? This is how to get the depreciation percentage. Clear? I hope so it is clear, right? Always remember 3 things. First, what is the depreciation expense? For depreciation expense, you will apply this formula under straight line method. Which formula? Cost minus residual value divided by useful life. Second thing, how to convert this depreciation expense to accumulated? Just multiply with the number of years. Right? Third thing, how to get the carrying value? Carrying value is always equal to what? Cost of asset minus accumulated depreciation. If you want carrying value at the end of 4th year, so you need accumulated depreciation of 4 years. Take cost minus accumulated depreciation. Okay? Sometime, just assuming here, sometime you have to calculate depreciation by using fractional method. Which method? Fractional period. Fractional period, it is also called time-based method. Time-based method. Please listen what I'm saying. For example, this asset, whatever example you were discussing, let's assume you bought on what? On October 1st of year 1. And you have to apply time fraction. Okay? If you bought on October 1st and your year end is how much? Your year end is what? 31st December. How many months are there? From October 1st till 31st December, there are 3 months. So you need depreciation for 3 months if time apportionment you are doing. So what you will do, you will take depreciation expense first, which is equal to cost, which was how much? 1 million. Residual value, which was how much? 100,000. Life was how many years? 5 years. Depreciation expense per annum was how much? 180. But you want in the first year only for 3 months. So you will multiply 3/12. So you will get fractional depreciation 45,000 for the first year. Right? Understood? Because this fraction sometimes we need to apply. Sometimes you might buy the asset in the mid of year, at the end of the year. Sometimes you might sell the asset in the mid of the year, right? The time fraction will be sometimes you need to apply. Please also note one more point. Sometime in your exam question, he will tell you this statement, whatever I'm going to speak now. He would say it is a company policy to charge full year depreciation in the year of acquisition and none in the year of disposal. It is a company policy to charge full year depreciation in year of acquisition and none in the year of disposal. And what? None in the year of disposal. And I'm assuming you bought asset on 1st October, year 1. You sold asset on for example, March 30th, year 3. In first year, what depreciation you will charge full year, regardless the date of purchase, like 180,000 full depreciation. In my example, 100 and in the year of disposal, don't calculate the depreciation of 3 months. Because what is the policy? None in the year of disposal. You will not calculate any depreciation. Understood? You have to focus on the question what he says. If question says this policy, you have to follow that policy in calculation. Understood? Clear what I'm saying? It's just English, and if he is telling you the application of policy, you have to follow while solving the question. Clear? If he asks you to apply fraction, so in the first year, 3 months depreciation will be calculated because you bought on 1st October. In the year of disposal, also 3 months depreciation will be calculated because you sold on 31st March. Right? If year end is 31st December, so 3 months depreciation will be calculated there also. Understood? Now we have here whatever 460 or 360, ignore my writing mistakes. Huh? Okay, guys, now thank you so much, by the way. So now, guys, we are talking about declining balance method. Declining balance method. Okay. This is second appreciation method. And what will happen under declining method? Please make sure under straight line method, every year you are getting same depreciation if you will ignore time fraction. Okay. And under declining method, what will happen? In earlier years, for example, if asset is having 10 years life, maybe first 3-4 years, or in the first year, depreciation will be higher, second year it will be lower, third year will be more lower, fourth year will be lower to lower. This pattern will continue. Right? Under straight line, under declining balance method. Declining balance method is also called written down value method. It is also called reducing balance method. Right? And this is the method, only method I would say. This is the only method in which we will calculate the depreciation based on carrying value, not based on depreciable base. Based on what? Carrying value. Don't worry, I will explain. In all other methods, we are using what? Depreciable base. What is depreciable base? Cost minus accumulated minus residual value. But what is the carrying value? Cost minus accumulated depreciation. In this method, we are going to use carrying value instead of depreciable base. And what is the format you will follow every year? Yes, I'm explaining. For example, at the end of first year, you want to calculate the depreciation. or at the end of second year, third year, whatever. So you will apply this formula. You will take cost of asset minus what? Accumulated depreciation. This will give you what? Carrying value. Carrying value you will multiply with what? With the depreciation percentage. Depreciation percentage. So this will give you what? Depreciation expense. This will give you depreciation expense. Right? Next year again you will repeat the process. You will take the cost minus accumulated depreciation is equal to carrying value multiplied by depreciation percentage is equal to depreciation expense. Over the life of asset, you will apply this formula. I will just apply, don't you worry. So, but what will happen over the years? Over the years, your accumulated depreciation will increase. Obviously, your carrying value will decrease, and you are applying the same percentage. So, obviously, your depreciation expense will also decrease over the years also. Okay? Understood? Okay, here make one note. If in question he is going to use the word double declining method, what? Double declining method. So what is the change? Just small change. If depreciation percentage is 20%, or if it was 20, and now he's asking you to use double declining, just you will double this rate. Double means 20 will become 40. If initially it was 10%, and he's asking you to use double, so 10 will become double. Double means 20%. That will be the only change. Rest of the formula will not change. And double declining method is just a way to depreciate your asset more quickly or more fast. Okay. And I told you another note also. In earlier years, you will get high depreciation. As the time will pass, with the passage of time, depreciation will reduce. Understood? Ready? So let's do a small example again, and I will just solve. This is the same example. We have same cost of asset. How much cost of asset? 1 million. And here I will solve it because I want to show you one point. And we have here, if you will take cost less salvage value, this will give you a depreciable base. I told you under declining method, you are not going to use depreciable base. You are going to use carrying value, right? And I'm assuming useful life is how many years? 5 years. Can you convert it into percentage? What is the depreciation percentage? Depreciation percentage will be 100%. Divided by life of how many years? 5 years, it will become 20%. And I am asking you to use double declining. I will multiply with the 2. So depreciation percentage will be 40%. I'm assuming we are using double declining. Right? So what we will do here, guys, look. This is how it is going to work. Or I can just tell you this way. This is also one way to solve. This is another way. First, I'm going to write here years. We have a year 1. Let me write first formula here. Formula is what? Cost of asset minus accumulated depreciation. It is going to give us carrying value. Multiply by depreciation percentage. This will give you what? Depreciation expense. And I'm making one more column for accumulated depreciation. So these are column. Okay. So here I'm writing year. This is, for example, year 1, 2, 3, 4, and 5. First year you are going to calculate depreciation. So guys, cost of asset is how much? Help me now with the calculator. It is 1 million. Accumulated depreciation is 0 because first I'm going to calculate. Understood? So carrying value will be how much? 1 million. Depreciation percentage is 40% because I'm using double decline. So depreciation will be how much? Can you help? $400,000. And accumulated depreciation will also be $400,000. Because accumulated means a total depreciation. Then guys, year 2, again cost is how much? 1 million. And accumulated depreciation will be how much now? $400,000. Carrying value will be $600,000 multiplied by 40%. How much? 240,000. And accumulated will become how much? 640. How? Because now this is the accumulated total. Clear? Or you can say this with this plus this is equal to cumulated. Total depreciation till date. Year 3, again cost is how much? 1 million. Now accumulated depreciation is how much? 640,000. So it will be how much? 360,000 times 40%. How much? How much? Please help me guys with the calculators. I want you to use actually because here I'm going to discuss one important point. $144,000. Now accumulated will be how much total? Can you add? 784. 84, right? 84,000. Now again you will take, see what's the magic now. We are moving to the actual magic side. So 1 million minus 784,000. It will give you carrying value how much? 216,000 times 40%. How much? 8,400. What is total accumulated now? 7,400. 400. Now next year again cost how much? 1 million. Cumulative depreciation is how much? 8,7,400. 100 and 600. Okay, if I will take multiply by 40%, can you just apply? Just apply. I'm changing color here. How much you got? 51,000. 51,840. 840. Okay, tell me now. If I will add these two values, it will exceed 900,000. Just add, just add. 870, 400 plus 51,000, 840. It becomes how much? 921. 940, right? Whatever arithmetical accuracy you can check. Okay. Now look, what rule I told you at the start. I told you your accumulated depreciation should not be more than depreciable base. Should not be more than. This is the point which I want to explain now. That's why. Your accumulated depreciation should not be more than depreciable base. And what is the depreciable base? Depreciable base is 1 million is the cost minus residual value is how much? 100,000. So depreciable base is. So see, it exceeds here. Right or wrong? Which is incorrect. What I have to do? It means in last year, I cannot apply 129,600 times 40% normal way of depreciation. No. Because if I will apply normal way in the last year, it will, my accumulated depreciation will exceed the depreciable base, which is not allowed. So it means in the last year, I need to calculate only balance depreciation. How I will get the balance? Look, I'm removing these values now. Because my previous accumulated depreciation is how much? Previous 870, 400. How much if I will write it here? I guess which will be 29,400. Then it will be equal to. It will be equal to what? This is what I want. It means in the last year I can calculate only the depreciation how much? 29,400, not 51,840. Understood? How you got the balance? This balance how you got? Depreciable base less accumulated depreciation of the last year. Depreciable base is 900,000 and accumulated depreciation of the last year is how much? 870,400. So it means this is the balance which I can calculate. It means I have to remove these values. I have to remove these values. So this will be the balance of depreciation which I can claim. I cannot claim 51,000 and something. Clear? Got it? Okay, in exam question, for example, if this is the question and they will ask you, if they will ask you what is the depreciation expense for second year, from this table you have to find. Depreciation expense for second year, what is the answer? 240,000. Right? If you will ask you what is the cumulative depreciation at the end of third year, then answer is 874,400. Right? If he is asking you what is the carrying value at the end of second year, carrying value is what? Cost minus accumulated depreciation. Cost is how much? 1 million. What is accumulated depreciation at the end of second year? 640. So the carrying value will be how much? 360,000. Right? So this is what he can ask you maximum. Let's discuss now third method, which is called sum of years digit method. And then I will do some comparison to solve theoretical questions. Okay? The solution is solved here also. Okay, so last balance 29,600. Okay. This comparison I will explain later. But first understand what sum of years digit method. This is the name. Sum of the years digit method. Actually, it is just a different way to calculate the depreciation. But its depreciation will be similar to the declining method. Like its pattern is same. What will happen here? In earlier years, it will give you higher depreciation. And in later years, it will give you low depreciation, same as it was happening under what? Declining method. In declining method, it's also happening same. See, in declining method in the first year, what was the depreciation? 400, then 240, then 144, then 86, then 29. Same pattern, not same amount. Same pattern will be under sum of years digit method.
Are we using this method?
So guys, here now let's understand how it is going to work. Sum of years digit method. For example, if useful life, what you first read this, it's important. Sum of the years digit method is one of the accelerated methods of depreciation that provides higher depreciation expense in the early years and lower charges in the later years. Same as I told you, like declining. Second statement here, why it's called sum of the years digit. Here what we are going to do, we are going to first of all, each year is progressively numbered. I will tell you. And then what? Added. For example, if your asset life is, let's assume 3 years. So you will write like that, year 1 plus 2 plus 3. Total will become 6. This is called sum of years digit 6. If life is 5 years, 1 plus 2 plus 3 plus 4 plus 5. Progressively we are writing. And the total will be how much? 15. Sum of years digit will be 15. Right? If life is 50 years, now you are stuck. If life is 50 years, so you can't do on in your paper 1 plus 2 plus 3 plus till 50, right? So there is a shortcut formula to get the sum of years digit. And what is that formula? Sum of years digit. The formula is, this is the formula. What is the formula? You have to take n. N stands for useful life. Multiply by n plus 1 divided by 2. For example, asset life is 50 years. So sum of years digit will be how? 50 multiplied by 50 plus 1 divided by 2. Just solve 50 plus 1, it will become 51. 51 multiply with the 50 and divide with the 2. 1, 2, 7, 5. This is the sum of years digit. Okay. For example, if your asset life is 5 years, so total was 15, right? So you can apply same formula 5 into 5 plus 1 divided by 2. So once you will take 5 plus 1, 6. 6 times 5, 30 divided by 2, it will give you 15. This works, huh? Okay. But this I told you only the what is sum of years digit. I didn't tell you anything how to get the depreciation. Okay, so that I'm going to tell you now. Look, guys, here what we will do, this point is also important. We always, every year, we always apply this formula to get the depreciation expense. I told you in short at the start, in every depreciation method, we will use depreciable base. Only there is a one method in which we will use carrying value. That is the declining method. Even if it's a sum of years digit method, you have to use depreciable base. And depreciable base, how you get? Cost minus salvage value. This is called depreciable base, right or wrong? And what I'm calculating, I'm going to calculate depreciation expense. By using which method? Sum of years digit method. So what is the formula? I need depreciable base, which is equal to cost minus salvage value, multiply by remaining life of the asset, divided by sum of the years digit. Okay, please one make sure. This remaining life, at which point, not at the end of the year. It is at the start of year. At the, okay, depreciation we calculate at the end of year. But this remaining life you have to take as you are sitting at the start of the year. For example, let me tell you what I'm saying. For example, asset life is 3 years. So what is progressive in number? 1 plus 2 plus 3. So it total will be 6. So what is the formula I have to apply? Let's say I want to calculate depreciation for year 1, 2 and 3. These are the years. I'm writing years. What is the formula? I have to take a depreciable base, multiply by what was the formula? Remaining life of the asset at the start of the year. If you're sitting at the start of year, how many years are remaining? 3. 3. Right? So I will take 3 divided by sum of years, which is 6. In second year, what I will do? Again, I will take depreciable base. Now you're sitting at the start of second year, assume. So what is the remaining life at the start of second year? It is 2 by 6. Right? And it in year 3, it will be 1 by 6. Depreciable base into 1 by 6. Right? Right or wrong? I can tell you another way also. If this is hard for you, why you are taking remaining year, but it's logic I told you. I can tell you this way also. Look, for example, this is your year 1. This is the year 2. This is the year 3. Let's think this is useful life. How many years are useful life? How many years? 3 years total. So you can write reverse counting. 3 plus 2 plus 1. Total will be 6. In first year, how you will do? You will do 3 by 6. In second year, you will do 2 by 6. In third year, you will do 1 by 6. Multiply by every value depreciable base. Multiply by depreciable base. Multiply by depreciable base to get the depreciation expense. Okay? Whatever is convenient for you, you can write that. Clear? If asset life is 5 years, then first I will write years. 1, 2, 3, 4, 5. And then for the sum of years digit, I will write the reverse counting. Reverse counting what? 5 plus 4 plus 3 plus 2 plus 1. Total is 15. In first year, it will be 5 over 15. In second year, it will be 4 over 15, 3 over 15, 2 over 15, 1 over 15. Multiply by depreciable base. Okay? If you have a problem with the remaining life at the start of the year, you can do this. Understood? Now let's do a small example. Here we go. Assume that an asset cost is how much? $11,000. This is the cost of asset. Okay. It has salvage value of how much? $1,000. It has estimated useful life of 4 years. Right. So you can write the counting 4 plus 3 plus 2 plus 1. Total is going to be 10. Right. Total is 10. So what I will do, first I need to calculate depreciable base. Depreciable base is cost minus residual value is equal to depreciable base of 10,000. Now how I will calculate the depreciation? I will write the year, first year, second year, third year, fourth year. And in the first year, what I will do? Because remaining years are 4. If you are sitting at the first year, at the start of first year. So I will do 4/12 multiplied by depreciable base. So this will give you depreciation for the first year. In second year, I will do 3/12 multiplied by depreciable base. It will give you depreciation expense for second year. In third year, 2/10. Maybe I'm saying 12. It is 10 now. 2/10 times 10,000. This will give you depreciation expense. In fourth year, 1/10 times 10,000. This will give you depreciation for the next year. And see, your total depreciation should never exceed the depreciable base. Understood? Clear? This is which method? It was sum of years digit method. Understood? Now I want to do some comparison also before moving to the next. This comparison you should remember. This table is important to solve analytical type questions. First, let me tell you here this column for depreciation expense. This column is for profit. This column is for retained earning. This column is for accumulated depreciation. This column is for carrying value, which is called net value or net book value or book value or balance sheet value. Okay. So here I'm comparing two methods. I'm comparing what? Straight line with what? DM. DM stands for declining. Or SYD. SYD stands for sum of years digits. Because declining and SYD is having same way to get depreciation, same pattern. Higher to lower, right? Higher depreciation to lower. What will happen? And you can see here this overall row for earlier years. This is row for what? Later years. First, I'm comparing early years. In early years, if you are using straight line or you are using declining at SYD, you will compare these two methods. These stand for examiner. So which method will give you higher depreciation in earlier years? Straight line method always gives you lower. If you remember, in straight line method, every year depreciation was 180,000. But under declining method, first year depreciation was how much? 400,000. Under declining, we did the example, you can refer back. It means, see, straight line method will give you earlier year lower depreciation and declining will give you higher depreciation, right? Then guys, what if now depreciation you are going to relate with the profit? Depreciation is your expense. Lower expense mean to say higher profit, and higher expense mean to say lower profit. You know better than me, right? Because you are doing daily basis calculations also. Then profit and retained earning have direct relation. Because same profit from income statement you transfer to the retained earning. Higher profit mean to say higher balance of retained earning. Lower profit mean to say lower balance of retained earning, right? Done. Then guys, I'm going to link with the accumulated depreciation. So for this, you need to just look this column. Depreciation expense to the accumulated depreciation. Guys, because if depreciation expense is lower, obviously accumulated depreciation will also be lower. If depreciation expense is higher, accumulated depreciation will also be higher. Right? Now you can relate depreciation with the carrying value, accumulated. Whenever accumulated depreciation is lower, carrying value will be higher. Whenever accumulated depreciation is higher, carrying value will be lower, right? In exam, how we will ask you, you have to memorize the table now. Maybe we'll ask you, company is planning to use declining method, right? And they are going to replace declining straight line with the declining method. In earlier year, which method gives you higher profit? In earlier years, you have to look earlier years. This is profit. Higher is given by straight line, right? And what will be the factor on carrying value? Which method gives you higher carrying value or lower carrying value? So you have to remember this table. If you know the earlier years data, in later years, it will be totally opposite. Look, here this is SLN. Straight line, this is straight line. Here it was lower, it will become opposite higher. Right? If it was higher here, it will become lower here. Totally opposite. Just reverse the scenarios in later years. Understood? If this value under declining method, it was higher. In earlier years, in later years, it will be lower. Totally opposite. Just memorize the first area. Second area is totally opposite in later years. Understood? This is called which method? Sum of years, digit method. Clear? Now I'm going to explain method number 4. Units of output method. Fourth method we are going to discuss. Units of output method. It's also called depreciation based on actual production. Just after this, we have 2 more methods to go, then we have a questions. In total 6 methods I'm teaching. This is 4th one. Understood? So here we are going to talk about units of output method. What it is, it's very simple. Here, first remember the formula. What formula you will apply to get the depreciation expense every year. I can give you practical example like Dubai taxi, when they buy any new car, so they have pre-planned that this car maximum will be used for example, 600,000 kilometers max. I'm assuming up to how many kilometers? 600. And in first year they drove, or for example, if they drove only 200,000 kilometers, how they will get the depreciation? They will take actual usage, which is 200,000 kilometer, divided by total expected usage, which is how much? 600,000 kilometer, and they will multiply with the depreciable base to get what? To get the depreciation expense. Maybe in the next year they used only 50,000 kilometer. So in next year they will take 50,000 kilometer divided by total expected usage is how much? 600,000 kilometer multiplied by depreciable base. This will give you depreciation expense. Right? It means what formula we are applying? We are taking actual output divided by total output expected multiplied by depreciable base. If there is no actual output, no depreciation. If more actual output, more depreciation. Less actual output, less depreciation. Done? No output, no depreciation. Right or wrong? This can be also applied on photocopy machines. If you're using machines for maybe 200,000 copies, 1 million copies, you can depreciate over the actual number of copies. Right or wrong? So here we go. Let's do the small question. For example, we have the same question. We have historical cost, how much? 1 million. Residual value is how much? 100,000. Depreciable base is how much? 900. And we have here additional data. What? We have data in year 1. This is your actual production of year 1. We have produced 2,300 units. In year 2, how much? 2,000 units. In year 3, 1,800 units. In year 4, 1,200 units. In year 5, 700. So just you will make the total. Expected is how much? I'm assuming actual and total. Expected is the same, but this is the actual production in each year. Okay. So how you will depreciate now? Very simple. First, you, as I told you, will take depreciable base multiply by actual production divided by total production, right? Right or wrong? In the first year, in year one, depreciable base is 900,000, right? And actual production is how much in year one? 2,300. Divided by total is how much? 8,000. So you, once you will multiply this, you will get depreciation expense. In the last year, what you will do last year? Actual production is how much? 700 divided by total is how much? 8,000. So 700 divided by 8,000 multiplied by depreciable base. This will be the depreciation expense in the last year. Understood? Clear? I don't think so there is any rocket science. It's very simple. Just take depreciable base, multiply by actual output divided by total output multiplied by, oh sorry, this will give you a depreciation base, depreciation expense. Okay, because what is the formula? Depreciation expense is equal to depreciable base multiplied by actual output divided by estimated output, total, which should be total, right? This will give you depreciation expense every year. Clear? Understood? Okay. Now we have a method number 5, component method. Actually, it is not a separate method, guys. It is a straight line method. Which method? But here, what's the difference? For example, you bought an aeroplane. Now, aeroplane engine life is different, and exterior body life is different. Maybe exterior body can last for 40 years, but engine you have to replace maybe every 5 years. And engine cost is also very big, important material. So now I cannot depreciate the whole plane over 40 years or over 5 years. It's hard for me, right? So what I have to do? I need to follow component method. Like body should be depreciated over 40 years. Engine should be depreciated over 5 years. But here I need first break up the cost of the body and the cost of engine also, that should be depreciated, right? Right or wrong? This is called which method? Component method. Where each component is having different life and the amount of component is significant. This is the condition. Don't do, you have component of 3 dirham or $3 you are going to depreciate. No. It should be significant, big enough amount. Otherwise, you will just increase your work. Right? But it is a straight line method. Which method? And what was the formula? Cost minus residual value divided by life to get the depreciation. So here we go. Let's have a look with this example. By the way, this method is allowed by US GAAP, but this method is rarely used. Under IFRS, they are using more if each component is having a different life and component is significant. Obviously, it is allowed by GAAP also. There is no difference, but people use this method rarely. Okay. How it is going to work? Read the question, please. This is the question. Read from here till here. You read it? So what they're telling you, obviously, I also have gone through this question. So there are 3 things. One is a machine, which machine cost is how much? 225,000. Machine life is how many years? 20 years. Okay, then inside machine we have one cylinder, which is significant. Amount is how much? 20,000. Life is how many years? 5 years. Then we have an inspection cost which needs to be done every 10 years. The inspection cost is how much? 5,000, and its life is 10 years, because every 10-year inspection is required. So obviously we have to depreciate now, and it's a straight line method. You don't have any residual value. You are applying this formula: cost minus residual value divided by life. So there is no residual value. So simply I'm dividing cost with the life. So machine cost is how much? 225,000. Life is how many years? 20. This is the annual depreciation. Understood? Cylinder cost is 20,000. Life is 5 years. Annual depreciation is 4,000. Inspection cost is 5,000. Life is 10 years. Depreciation is 500. So the depreciation in the first year will be how much? 15,750 for all components. Right? Right or wrong? Understood? So this is what is the component method. And now you can record your asset in balance sheet. Like, you don't need to show their inspection cost separate, cylinder separate, and machine separate. You can show one category machine and machine cost, total cost. This will be the total cost. This will be the total depreciation. It will give you carrying value. But this working should be with you, right? Right? Clear? Okay. Then guys, we are going to talk about what? Group, or it is also called composite depreciation. Group or composite depreciation. Again, it is extended version of straight line method. So let me tell you first what it is. For example, you have 1,000 machines. 1,000. Okay, maybe it is not practical to depreciate 1,000 machines separately, right or wrong? Maybe they bought also at different point in time. It will extend my work if I will depreciate each machine separately. So I can make a group. Here standard allowed us to make a group. Like one group of machine and depreciate one time. No need to depreciate 1,000 machines 1,000 times. Right? So this is called what? Group or composite method. First understand theoretically what it's written. Composite assets is the way of what? Grouping many assets. We're going to make a group so that their total cost is carried by and depreciated as one asset. Because you're going to make a group. Composite method is apply what? I told you it's extended version of straight line. But this method tells you how you can save your time. Right? Okay, now there is one more problem is there. What is the problem? I have 1,000 machines. One machine is having life of 10 years, second is having 11 years, third is having 12 years. So once I will make a group, again there is one more confusion. This group should be depreciated on how many years? Number of years. It's a confusion, right? 10, 11, 12. No, we need to get average life for that. What? This is a very shortcut way to get the average life. Then regardless of the actual life, we will depreciate the whole group on what? On average life. Okay? Actually, it is just a quick way to calculate the depreciation, which is composite method. So here we go. Let's have a look with the help of example. Straight away, I will explain with the help of example. Okay? Then what formulas are there that I will explain with the help of example. So here we go. For example, for its first year of operations, a company used the composite method of depreciation and prepared the following schedule of machinery owned. Here we are going to make group of machines. So we have machine X, machine Y, machine Z. And these are the total cost of those machines, actual cost. Machine X cost is how much? 320, Y 180, Z 80,000. And these are the residual value. You can see for one machine residual value is 0, not given. Right or wrong? If not given, put 0 there. And these are their what? Estimated useful life. Every machine is having different life, right? I want to use group method here. I don't want to depreciate separate. So group method, what I will do, this is the application of group method I'm going to tell you. And I need your concentration. It is just 2-3 minute thing if you will understand. First, I will write machine X, Y, and Z. And here, total cost is how much? 320,000 for machine X, for Y, 180 for Z is 80. So these costs I'm just paying it down. Right? Actual data. There is no residual value. Oh, yes, we have. Minus what? Cost minus salvage value. This is called depreciable base, right? Is equal to depreciable base. So salvage value is given for machine X and Y. For Z it is 0. We wrote. Now cost minus salvage value, you will get what? Depreciable base. Now each depreciable base I will divide with its own life. First year you have to do this. In second year on single click you can do the depreciation calculation. But first year you need to do this working. So guys, you got straight line depreciation how much? For machine X is 14, for machine Y is 16, for machine Z is 10. So total depreciation is how much? 40,000. Next year you don't need to do this recalculation. From this calculation, I will calculate two things here. Initially, I will calculate what is the depreciation percentage for whole group. And I have to calculate what should be the average life over which it should be depreciated. Understood? In the first year, you have to calculate these two things. Then calculation will become very easy in future years. So how to calculate what depreciation percentage? So here is the formula. Depreciation rate. It's called weighted average rate. What is the formula? Total annual straight line depreciation divided by total acquisition cost. Tell me annual depreciation is how much? 40,000. And cost is how much? This is initial cost 580. Now depreciable base. Cost 580,000 and multiply by 100. This will give you depreciation percentage. 6.896666% like that. Okay, you got the rate. Second thing you need to calculate what? Average life. Because there is a problem. One is having 20 years life, second is having 10 years, third is having 8 years. So average for average life, you can apply this formula for average life. What is the formula, guys? Total depreciable cost. Depreciable cost means a depreciable base. Depreciable base is here. 520,000 divided by annual straight line depreciation. Annual depreciation is how much? 40,000. If I will divide, I will get average life of 13 years. And maybe you might think, sir, I can get average life this way also 20 plus 10 plus 8 divided by 3. What if you have 1,000 asset? Right? It is very hard for you. Right or wrong? So follow this formula. What's the formula? Total depreciable base divided by annual depreciation. Now it means what we learned from here. It means this whole group of machines I will depreciate over 13 years now. Over 13 years. Right? On average life of 13 years. And how you will get the depreciation in year 2 now? Normally, you will apply the normal formula now. Because from year 2 to 13 now, every year, single calculation or single working you have to show. What is the working? You have to calculate periodic depreciation. Is equal to what? Cost of asset, which are in use, not idle, used, which are in use. I'm assuming all assets are in use. Multiply by what? Weighted average rate. Cost of asset is 580,000 original cost. It's not a depreciable base. It is a cost. Because when you apply percentage in straight line, you have to apply on cost. Ignore the residual value, okay? Because residual value is adjusted in the calculation of depreciation percentage automatically. Because depreciation percentage, how you took depreciation there. Right or wrong? Which is already, you have adjusted residual value there. No. So here, depreciation rate, how you calculated? How you calculated depreciation rate? Annual straight line depreciation. Oh, dear, this depreciation, the 40,000 depreciation already includes the factor of residual value or not? This 40,000 depreciation already include, because you deduct cost less salvage value, then you got depreciable base, then you divide years, so it automatically included there. Right? That is why when you apply here, you have to take just a cost of asset, multiply by depreciation percentage which you got. Okay, cost of asset is, and this is the depreciation percentage actually, the full value. So if you will multiply, you will get annual depreciation is 40,000. Maybe you might think, sir, why we need to do this? First year I got 40, I know straight line method. Every year it will be 40, 40, 40. This you know, I can understand. But you have to show the working, right? To the auditors, if your accounts are being audited, right or wrong? Maybe to the examiner, if question is tested. Right? This is just a shortcut way to calculate the depreciation quickly by grouping the assets. Understood? Otherwise, it's a straight line method. There is no rocket science. Clear? Now I'm going to show you some exam standard question. Okay, even answers are there. Don't worry about the answers. But we have to read the question and we need to understand. Question number 1. Take time and go through, guys. So what they're saying, which one of the following method of depreciation will result in lowest reported net income? Reported net income is the method in which depreciation expense is higher. Depreciation expense is higher. Obviously, profit will be lower there. And he told you in what? Early years. In earlier years, declining method or sum of years digit method. These two I wrote together, right? Declining or sum of years digit gives you higher depreciation. It means income will be lower. Straight line method gives you lower depreciation. It means income will be higher. Question is about where lower income. It means where higher depreciation. Number 1 group. No, I didn't say group is straight line method. Yeah. Straight line, it's straight line. Composite is also straight line. So only sum of years digit method will give you higher depreciation expense, lower net income in earlier years. Understood? Clear? Question number 2. It has nothing to do with the depreciation. This question. This we studied cash flow statement, right? Statement of cash flows. In statement of cash flows, I told you ledger accounts for property, plant, and equipment. Actually, it is from there. But I want you to go through first. Read it? No worry, I will explain. Guys, here you have to calculate the carrying amount of property, plant, and equipment disposed during the year. Actually, the one equation we studied in statement of cash flows. The equation is you have to take opening carrying value of asset plus cost of asset purchased minus depreciation expense for the year minus carrying value of asset disposed is equal to ending carrying value. What? Ending. This is the equation. Just write the values whatever is given and work with whatever is not given. Beginning carrying value, how you will calculate? If you will take cost, this is the beginning because you are sitting in year 2, right? Right or wrong? It means ending value of year 1 will be beginning for year 2. So what is the carrying value? Beginning carrying value. You will take cost of asset of last year minus accumulated depreciation. Can you tell me how much it is? 193,000. So this will be 193,000 beginning carrying value. And this is the ending carrying value is given. Take cost of asset which is 340 minus 119. How much? Solve it, please. 221,000. So I got ending carrying value also. Cost of asset purchase is given how much? 65,000. And depreciation expense is given how much? 30,000, which is negative value. Yes, I can work with this value now. I can go reverse. Right or wrong? Because if any item from these will be missed from these, I have to go reverse. If final item is missing, then I have to come straight away. Now I have to go reverse. On calculator, what I will do? I will take ending carrying value. I will take 221,000 on my calculator. When we go reverse, plus will become minus, minus will become plus. I will plus 30,000. Doesn't going reverse. I will deduct 65,000. I will deduct 193,000. And on your calculator, you will get a negative value of 7,000. Because it is actually the negative value. Right or wrong? So this 7,000 is your answer. Clear? Not only carrying value of asset disposed, if anything is missing from here, anything, you can go reverse, right? Maybe he can ask you to calculate cost of asset purchased. You can also ask you to calculate depreciation expense, right? By using this equation. You have to open your mind, please learn the things. It's not a rocket science. It's just a one equation and application of that. Understood? Great. Another question. Go through please this question. What you have to do, you have to use by using which method? Double declining. So you have to calculate depreciation expense on the truck for its second year of use. Declining, double declining. First tell me what is the formula? You have to write cost minus accumulated depreciation is equal to carrying value multiplied by depreciation percentage is equal to depreciation expense, right? Right or wrong? And for 2 years, I have to do. For second year, I need to get the answer. What is the cost of asset? Guys, you bought this asset for how much? 38,600. Plus you added storage bin. This is capital expenditures because you added it is going to increase the capacity of the track. So this both you have to add. This will give you cost. What is the cost? 40,300, right? Can you add? 40,300 is cost. Both have to add capital expenditure also. Minus accumulated depreciation first is 0 because I'm going to calculate the first one. This will give you carrying value 40,300 multiplied by depreciation. I don't know what to do. It has life of 5 years. So I will take 100 over 5. It will give you 20%. Multiplied by 2. It will give you, because you have to do a declining method, double declining. That's why you have to double the rate, right? Because 20% is normal rate. 100 over life. Life is 5 years. 20 is normal. You have to use double declining, right? So it will be 40%. So time 40%. Can you tell me what's the first year depreciation? 10. No, it is 40,300 times 40%. How much? 16,120. Next is what will happen? Cost is same. Accumulated depreciation, this will become accumulated obviously. 16,120. Can you help me? How much? 24,180 times again 40. So this will give you 9,672. This is actually the answer because you have to calculate for second year. This is the answer. Okay? Understood? Then guys, another question. Go through this, please. Majesty Amusement Park recently installed a new thrill ride. Although this attraction has an average life of 40 years, Majesty estimates that the ride will be popular for 15 years, at which point it will be disassembled. Now even life is 100 years, but you have to look useful life for you. Okay? And replaced with a different ride. What they feel, it will last for 40 years or it will last for 15 years? It will last for 15 years and then it needs to be replaced. So obviously then it should be depreciated over 15 years. Right or wrong? Rather than 40 years. So this is the question. Park attendance is based upon the local economy, which is difficult to predict. The method Majesty should use to depreciate the ride, because you are provided with a useful life only. So you should use which method? Straight line is 40 years? No. Because your intention is to use for 15 years. That is useful life for you. So you have to apply straight line method with 15 years. Units of output method cannot be applied because you cannot predict the public, which we will use. Right? Declining method you cannot use also. Right or wrong? Because here if you look at the formula, there is no data about cost is given, no information about accumulated depreciation is given, or about residual value, but at least life is given. So in straight line method, we use life. So straight line method is better. Okay? The option is correct. Read this question. I will solve this question from 2 different angles. Let's go through. You read it? What happened here? It is which method you have to apply? Which method? Did he tell you anything? I didn't read the question. So they are saying on January 1, year 1, an entity purchased abandoned quarry for $1.2 million. This is the cost. To be used as a landfill to service its trash collection contracts with nearby cities for next 20 years. The entity depletes the quarry, means depreciate it, using how much units of production? It's output method. Right? Based on the survey's measurement of the volume of quarries pit, the amount was 500,000 cubic yard when purchased. This is total estimated. Cubic yard, how much? 500. And 350,000 cubic yards at the end of year. It is remaining. It means how much you have used? 150 you have used. Understood? Because total estimate was 500 and remaining at the end of 5 years is 350. It means used is 150. So what is asking? What is the net amount? Net amount mean to say carrying value you have to calculate. Okay, at the end of the year 5. How you will calculate the different ways? First way could be what? Cost minus accumulated depreciation is equal to carrying value. Cost is how much? 1.2 million. Minus accumulated depreciation, how you can calculate? Units of output method, you have to take depreciable base, which is cost minus residual value. There is no residual value, right? So cost is depreciable base. Multiplied by actual output is 150,000 divided by total output is how much? 500,000. This will give you accumulated depreciation, right? Because 150 you used. Can you calculate how much? 360,000, right? I hope so. Okay, so carrying value is how much? 840. This is the answer. The second direct way to solve it. You can solve this way also. Because you want to calculate depreciable base. Sorry, you want to calculate carrying value. It means carrying value is what? Carrying value is the amount which is not depreciated, right? Which is not depreciated. And I can calculate how 1.2 million is the cost, a depreciable base, multiply by how much is remaining? 350. Right? And what was the total? 500. So this will be direct carrying value 840,000. Because carrying value is what? Which is not depreciated. Right or wrong? Which is not depreciated. 350 is remaining. It means this amount is not depreciated. 350 out of 500 is remaining. We can take 350 over 500, multiply by depreciable base. This will give you carrying value directly. But follow this. This is easy for you, right? Calculate cost minus accumulated depreciation. The accumulated depreciation is what? This is depreciable base. This is the actual output. This is total estimated output. This will give you cumulative depreciation. This is your carrying value. Okay? Understood? Thank you so much, guys. See you next time with intangible assets. Okay, you have to practice the question now from topic 3.4 from the software. It's completed today. Thank you so much. See you in the next class. Thank you so much. Bye.